Hello and welcome to With Wellner Anderson. This is the channel where we talk about economic, financial, and we talk about business things in simple terms. This is our monthly report on the updates on what's happened October 2022. And we can start this way by saying that we are in recession. We are in technical recession. There have been 2 consecutive quarters of negative gross domestic product, which we're going to explain what that is. And I'll be candid with you, I'm not an economist. I am a researcher. Guys, I haven't seen anything like this in a long time. I think we're in some trouble. Well, I mentioned gross domestic product. That's how governments determine how well they are doing. And gross domestic product is the total of goods and services that a country produces in the finished mode. What I'm saying is that this is a finished product, okay? Anything that has been made in that particular year, a house, a car, goes into the gross domestic product. If it was resold from another year, it doesn't go into the gross domestic product. So so now we know that what GDP is. What are the signs of recession? Low wages. That's not happening now. Okay? I mean, right now, as we speak here in October, wages have been pretty strong. Credit tightening, that's happening. Unemployment rising, not yet. This is a real weird situation. That's why I'm dwelling on this. I haven't seen anything like this since the 70s, and I don't even know if it meets that standard. Slow growth in housing. Housing sales are slowing. Typically, a sign of recession is there are more renters than buyers. Credit costs increase, which we talk about. Part-time workers increase, which is happening. Corporate downsizing, right-sizing is beginning again. The markets are dropping. Bond rates are rising. And maybe eventually deflation. So we are in recession. Now let's talk about, we did mention about the Fed and central banks. The role of the Fed or the central bank is to manage the money supply. Now, I mentioned before that for 15 years, we have, I believe I mentioned for 15 years, the Federal Reserve has kept interest rates low. If I didn't mention it, I'm going to tell you what that means. By having low interest rates, people who would normally borrow money for something might borrow that money and take a chance because the rates are so low. Whereas if the rates were higher, they may not take the risk. In other words, it creates an environment for risk by having low rates. And let's talk a moment about some of the tools that economists use to measure where or what's the climate of the economy. There's something called the federal funds rate. The federal funds rate is the rate that is paid from one bank to another bank to borrow money overnight. What I mean by borrowing money overnight is when a bank has to open in the morning, they have to have enough reserve to do the transactions, and banks borrow from each other. A bank borrowing from a bank is the most secure type of loan you can have. So the interest rate is going to be really low. To draw that in connection, if the Fed funds rate is, let's say, 4%, there's something called the prime rate, which is the rate that a bank would charge to its best customer, non-bank, which is usually 3% more. Okay, so now you know the reason why the Fed fund rate is important is because that's the first indication that interest rates are going up or down. Okay. Think of it this way. If you ever saw the movie It's a Wonderful Life, and George Bailey, the bank owner, comes into the bank, there's a line of people are starting the bank. This is A Wonderful Life from 1947, I believe. And you have all these people wanting their money out of the bank. In terms of the federal funds rate, if George Bailey did not have enough money in reserves in that bank, he would have to close the bank. So that really ties down what piece of that that is. Another indication are the markets, and what I do is I follow the Standard & Poor's 500. And the economists use the Standard & Poor's 500 to measure how the market is doing, because the Standard & Poor's 500 has the broadest market that's large enough that reflects the U.S. economy. And I tracked it from August to now, and we are about 15% lower than we were in August 14th, and this is October 22nd. That's not a good thing. It doesn't have a direct correlation to interest rates, but it tells us about where the confidence people have in the stock market. Another tool the economists use is called the ISM PMI. It is the Institute of Supply Managers Purchasing Managers Index. This is extremely critical, and it's important for you to understand how this works. What happens is there'll be maybe 400 or 500 purchasing managers that will be polled about how they feel the economy is going to evolve within the next 6 months. They are asked, are they planning to hire? Are they planning to fire? Are they raising prices? Are they expanding? What do logistics look like? What does the supply chain look like? What do the orders look like? What does the funding look like? From all that data, the ISM PMI come up with a number. And when that number drops below 50, that is a flag that these managers are losing confidence, or these managers are not planning on expanding their ventures. And right now I believe, and I think it's coming out today or maybe yesterday, but I believe for the first time the ISM PMI number is below 50. What that means is anything above 50 is normal. When you drop below 50, that's when some questions evolve. Another tool the economist uses called the yield curve inversion. I'm going to make this really simple. I'm not going to get into high school geometry, but if you do know a little bit about it, it'd be helpful. A yield curve inversion is when you take a 2-year bond and you take a 10-year bill. I mean, a two-year note, and you take a 10-year bill. And normally one would think that I'm going to pay you more money if you let me hold your money longer. Because the risk of something happening over 10 years is greater than the risk that's happening over 2 years. But when the government is willing to pay you more for 2 years than 10 years, it's the opposite effect. It's saying to people that I don't have confidence to wait 10 years for a higher rate when I can get 2 years for a lower rate. So in other words, it's a confidence problem. The yield curve inversion is a major tool that's used. Also, the unemployment number is a tool. In July of this year, 2020, we had 3.5% unemployment, and in August it was 3.7. So we're in for some really hard times. We're in for some really hard times. Let's go to a couple of points now that's going on right now that you need to be concerned with. And this is probably the most important thing of the entire video I'm giving you. Is these are some data points that are out that may affect you or us before we meet again in 4 weeks. The Biden student loan program to give everyone $10,000 is now tied up in the courts. I'm going to give you my professional opinion. I'm not a lawyer. But funding bills begin in Congress, not by the president. The president does not do funding bills. The Congress does the funding bill. This is a funding bill. The odds are the courts are going to throw this out. Inflation, 40-year high. A new UK Prime Minister. Unemployment is beginning to rise. Inflation is locked in. Now this is going to really sound scary, guys. But there may be a pending railroad strike. And if that happens, you ain't seen nothing yet. Economists are saying there is a 100% chance of recession in 2023. Guys, we're in recession. We're in recession. Also, a couple more points. Mortgage rates are rising. The latest I heard is they're up near 8%. Credit card spending is at an all-time high. They've got people using their credit cards to travel, to buy food. Also, what is the effect of the China shutdown going to be on the American economy? So, the final point is the strategic petrol reserve. This is amazing what I'm going to tell you. The current administration bought gasoline at about $40 a barrel. That went into the SPR, the Strategic Petroleum Reserve. I'm sorry, the prior administration, not the current. The Trump administration bought it at that price. The Biden administration is selling that for $85 a barrel. I estimate that's tens of billions of dollars profit that has come back to the U.S. government the risk of depleting our strategic petroleum reserve. This money, these 10 billions of dollars went into the general services of the United States and was spent. But wait a minute. We still have to put the oil back in the strategic petroleum reserves. And the current administration said they're going to buy that back at $72 a barrel. So here's what happened. The prior administration gave us barrels of oil at $40 a barrel. The new administration sold it at $85 a barrel, a $45 a barrel profit. Put that money into the general budget. And now they still have to buy back the oil from the strategic petroleum reserve. To me, that sounds like you're spending money twice. I don't get it. If someone knows what is going on there, please put in the notes. I really would like to know. I am totally fucking confused. Let me thank you for your time. I suggest that you click the subscribe button. This is something you might want to hear every month. And if you're on Facebook, give me a like. I thank you very much, and I'll see you next month.